You also increased your dividend, and I want to get your take on how you prioritize right now returns to shareholders versus growing production and capex.
So, Alix, as you know, we set out to build a real profitable business back in 1st January this year with the combination of Rand Gold and Barrick. And we've had a good run. It's 9 months into the new business, and my focus is, building for the long term. We have just come out with a 5-year plan for our organization, which sets the foundation of how we're going to run the company. And at the same time, we've delivered a lot, pretty much all the key deliverables that we set ourselves on the 1st of January. And of course, the gold price is up. Our business is running ahead of plan. And I've always said, when you beat your plan, you should always be mindful to give some of that back to the owners of the company.
And Mark, you're definitely known for being more conservative on that front in a good way, conserving your cash flow. But I'm interested in sort of as the gold price rises, again, I'm starting to hear, $16, $17, even $2,000 gold. I haven't heard that in about 8 years. Do you increase your capex? What's going to be the ratio? Gold price moves? What do you do with your capex?
So, I think the capex we set when we define our plans for each one of our operations. So the big focus in the beginning was to get our operations to be at our tier 1 or tier 2 level, which means they need to have at least 10 years life of mine. And we set those capitals. We've got some big capital projects next year, one being the Pueblo Viejo project in Dominican Republic. And then we've got some capital to spend in Tanzania following the taking private of Acacia. But other than that, the capital is already set for the next 10 years. And it's about delivering against that. And if you're right with the gold price, the margins are going to be great.
So do you see $2,000 gold, Mark? We talked about this many, many years ago.
Alix, I just think that, I've said this many times now, if you take all the gold projects and promises with respect to new gold mines, and you forecast what it's going to look like, by 2029, new gold production will be down 30%. If you balance that, so supply is forecast to shrink. Demand is definitely on the rise. We've seen more buying from central banks as they de-dollarize their balance sheets, and so I think the risk is more on the upside than the downside with the gold price.
Let's get to some of your more immediate things that you have to take care of, which is selling your Zambian mine. Do you have a target of when you're going to sell it, and can you give us some insight into the buyers?
So no, we haven't got a target at this stage. We've got nothing that we need to sell. Our biggest sale project at the moment, which is the only one we've announced, is Kalgoorlie out of Australia. It's a joint venture with Newmont Gold Corp, and it's a mine that we don't actually have an active participation in. We're an investor, and so that doesn't meet our criteria, and we'd prefer to sell it. And so we are busy with that sale process. We have said that we have as a target to realize more than $1.5 billion out of our non-core asset sales. We are working on those sales. Getting to Zambia specifically, you would have seen today we wrote back over $700 million in value from Zambia because our team has done such a good job in dropping the costs and improving the efficiency. So we've got some work to do in Zambia. And as you know, in Zambia too, there's a very dynamic situation within the mining industry in Zambia at the moment. And we in our Zambian Lumwana mine have a very large reserve and resource, but we don't have a roaster. And there are roasters in country which have huge capacity without the commensurate reserve base. So again, there's a natural pressure to rearrange the industry in Zambia, and we're certainly not going to stand by. We will definitely participate in that.
So to wrap that in then, is selling assets now easier or harder than it was a year ago in terms of the bid-ask price coming in and also the kind of leverage that the buyers are willing to take on?
So, Barrick's got no assets that needs to sell because they are poor assets. We've got assets that maybe might not fit our criteria, and that is our criteria is we want to make more than 15% internal real rate of return at a long-term gold price of $1,200 an ounce. And our tier one filter is more than 500,000 ounces for more than 10 years, and tier two is around 300,000 or 3 million ounces with production over 10 years. And so, but all our assets are profitable. So, I don't see, and we've certainly seen no resistance. We haven't really tested the market. We've had lots of approaches from people because this industry is short of assets, of gold production. And so there's certainly, and I've always said this industry needs rearrangement. It needs consolidation, particularly in the mid-tier range. You'll see that we've led the consolidation at the upper end of the industry, and closely followed by Newmont Goldcorp. So, but it needs still considerably more consolidation going forward.